Good morning. So we are still talking about the impacts of a Trump administration in this current Congress on crypto, blockchain, Bitcoin. We've already talked about Bitcoin, we've talked about stablecoins. Today I'm going to talk a little bit about the so-called tokenized real-world assets. And real-world assets, of course, are basically what we would usually call traditional assets. Things like, it could be, we've seen U.S. treasuries, it could be bonds, it could be real estate, it could be gold, it could be other commodities, it could be investments in private companies, it could be investments in public companies. All these potential real world assets that we just tokenize. So we put them in a token on a public blockchain. And the reason why we do that is, as I've talked over and over again, the reason why we do that is because now they're on the same database as everything else. So they can be more easily moved around, they can be more easily transferred, settled. They can participate in decentralized finance, which I'll talk about tomorrow. I can hold them, I can custody them myself, which is nice. There's much more transparency. So one of the reasons why we're seeing the likes of BlackRock and Franklin Templeton and Wisdom Tree and all these companies tokenizing funds is because it makes it more efficient. So what is this administration, the impact? Well, the impact is we're not going to have to, hopefully, we'll have some regulations that will help, so companies will feel more comfortable issuing these securities or issuing assets on chain and not worried that the SEC or someone else is going to come down on them. So one of those real world assets is what I talked about yesterday, which is stablecoins. Which is, a company is basically holding dollars or a treasury and issuing a token against them that just represents that dollar. Now, the growth in stablecoins, as I talked yesterday about possible stablecoin legislation, is going to add to the tokenization of the growth of these so-called real-world assets, because now, think about this, you're going to have something like a stablecoin like a USDT, or USDC, or PayPal USD or something. Maybe you've gotten paid in that, and now you're going to be able to pretty easily buy one of these other tokenized assets because you're just swapping a token for a token. And then you might own a BlackRock fund that's tokenized in your wallet, in your own custody. It's going to have huge implications, as we've talked about over and over again, huge implications in terms of how you manage wealth, in terms of what financial advisors do, in terms of the customizability, I don't even know if that's a word, customization of your portfolio, the personalization of your portfolios. It's going to have huge impacts there because of the transparency, because of the immediate settlement, because of the ability to know what's in your portfolio and move it around easily. So I think this administration, again, based on what they do with stable coins, based on what they're going to do in terms of tokenizing, the ability to tokenize assets. Keep in mind, when we start tokenizing other assets, when we start putting other assets on chain, in like real estate, like commodities, like gold, now we're talking about trillions and trillions of dollars worth of assets worldwide that are now going to go on chain. Some of those are publicly traded assets. So we're going to have public stocks on chain. We're going to have public bond issuance, private bond issuances on chain. You're going to get to build a much more personalized portfolio. But it all starts with being comfortable enough that the regulation is there, that we can issue these assets. We can issue these investments on chain and not have to worry too much about it.